So today we have a few things we need to cover, but I want to start out with a couple of logistics items first. So first, I heard some teams had some struggles signing up for Stock Track. So the deadline for the syllabus for Stock Track was actually last Friday. So basically, if you didn't sign up by last Friday, Stock Track wouldn't let you sign up because the link kind of became invalid. But yesterday, I got it extended through this Friday. So if you haven't signed up, you can click on the link. It'll work. But again, make sure that you sign up for Stock Track using that link by this Friday. All right, so the trading period has already started. So if you have an account as a team and you're trading, that's great. If you don't, get the account as quickly as possible. One of your team members will need to click on that link, pay the $31.95. But trading is open, so you can immediately start trading, subject to your teams obviously making some choices. Yes, sir.
Is there a requirement on how much you have to invest?
Minimum 10 trades.
No amount.
No, you can choose how much you want to invest, but minimum 10 trades in the first half of the semester. Okay. Other questions about Stock Track, but that should hopefully address the people that had trouble with signing up for Stock Track. Okay. The other thing that's going to happen is I'll call it good news, bad news. Okay. So the good news is that Mike Chello, who is, sorry, we're just getting a lot of background noise in the video. Sorry, I'm hitting mute right now. Sorry. Okay, so the good news is that Mike Chello, who is one of the creators of the 6th edition of the Valuation Workbook by McKinsey, and actually wrote the workbook that goes with it on sort of all the techniques for understanding, has agreed to come and guest lecture in the class. All right? The bad news is the only day he can do it is Wednesday, October 5th, which was originally Part B of the midterm. So as I look at balancing trade-offs, I think it'd be better for you guys to have the guy who helped write the book and can talk to you about a lot of this theory in practice show up. So I'm going to move the midterm to accommodate Mike. So this is what I'll call good news, bad news. So basically, the midterm exam, which I have to update on Elms, is going to be shifted back by 1 week. Okay, so the original exam, you can see this here, and I haven't made the change yet because I just spoke to Mike last night. But basically, if I go here and I look at the assignments list, that this exam, Part 1, is now going to be Monday, October 10th. Part 2 is now going to be Wednesday, October 12th. So that's going to be shifted back a week. All right, so Monday, October 3rd will be a regular lecture class, and then Wednesday, October 5th will be a guest lecture by Mike Chello. Okay, so I'll adjust this. I'll send out an announcement that does this, but the exam gets pushed back 1 week. Now, here's the thing. Apparently, there are some religious holidays both of those weeks. So a bunch of people said they were having trouble with Monday. Now we're going to have trouble with Wednesday the following week. So here's how I'm going to handle this. So for Part 1, Part A of the midterm exam, which is the economic statement conversion, you have to take it during class time on Monday, October 10th, but you can do it wherever you want. Okay? So just whatever your section you're registered for, you have 90 minutes of that section time. You have to take it and complete it during that specific time that you're registered for. But you could be at grandma's house as long as grandma has Wi-Fi and take the midterm. I don't have a problem with that, but you have to take it during that period of time on Monday the 10th. Okay? Now, Part B of the midterm, which is going to be a bunch of essay questions, I'm going to give you 5 days to take that Part B of the exam. Okay? But it's still 90 minutes. Okay? So Part A of the exam, Part 1, you have to take during class time on Monday, and you only have that 90-minute window. All right? Now, if somebody has a problem because of the shifted week, see me, and we can talk about any accommodations because I did shift it back a week. But Part B of the midterm, you can take any time between Monday and Friday, including class time on Wednesday. But when you click on it to start it, it will start a 90-minute timer clock. So you have to finish it within 90 minutes of starting it, but you have flexibility to take it any time during that week. Okay? Does that make sense? All right. Now, if you're wondering why I'm doing that for Part A and Part B, I'll just be honest with you. is that over the last 6 or 7 years of teaching this class, Part A is literally just the economic statement conversion. I give you an Excel file. It's just like homework 5 tonight. You convert it, and you have to finish it in 90 minutes. What I find is that in the 11 a.m. section versus the 3:30 p.m. section, in the 11 a.m. section to 3:30, they basically see a big dramatic change in grades. That generally people miss about 20% of the homework grade or the midterm grade in section 11 a.m., but by 3:30 p.m., the entire section gets an almost perfect score. All right? And I can't believe that the people in the 11 a.m. section are just really dumb. I don't think they are. I actually think they're pretty smart people. But it's interesting that throughout the day, the actual exam scores get better. All right? So that's hard to explain. So here's what's going to happen. That's why you have to take it within your section time. And there will be 4 different exams. So the exam that the problem set, that exam 11 a.m. section gets will be different than the one that the 3:30 p.m. section gets, just out of fairness. All right? And I don't want to give people extra time to pass around a solution file. Not that you would do it, but it's hard to explain the grading patterns that I see unless that's actually happening. So the only way I can do that is everybody's got to take it at the same time. Okay, so unless you have like some other excuse that I'll consider, but otherwise that's why Part A, because it's basically the numbers. Part B, which is a bunch of essay questions, I'm less worried about because there's no one solution to an essay question. That's why I'm willing to give you a 5-day period to take the essay questions. But I have to kind of hold firm on Part A just because out of fairness, I can't really be unfair to the section that takes it earlier in the day. So that's why I'm pushing that time constraint there. Yes?
What type of essay question can we expect? Is it just going to be like defending why we would buy or not buy?
So it could be as simple as back to, you did the analysis on Monsanto, so we'll talk about that in just a couple minutes, and I'll say, okay, what would be the rationale for why Bayer would be buying Monsanto given the data that you're looking at? So it's basically more open-ended. So one other word, and as we get closer to the exams, I'll remind you of this as well, but in this class, exams are open book, open notes. You actually have to use a computer, Excel, and a web browser in order to complete the exam. Because I don't believe in testing you purely on memorizing things. So asking you what the 4th word on page 267 of the textbook is, I don't find a lot of value in that in the exam. But here's the flip side. I also don't just let you just crunch numbers and say that's the sole solution for the exam. So in a way, that's what I am doing for Part A of the exam, is that you do have to crunch the numbers and you do have to get a solution, because I think that's just, it's fundamental to what we're trying to do in the class with understanding the way free cash flow is structured. But in terms of, do you actually understand the theory, then again, you would have had to read and absorb the theory to apply it. So that's really what the essay questions are more about. Do you understand what you're crunching? Okay, and so that's the way that I will test those. And since we have a guest speaker, I will definitely test some of the things the guest speaker talks about. Okay, so that will also be on the exam. I will tell you that. Okay, all right. Other questions? Yes, sir.
Can you put out like just a study guide or something, just like concepts that we can go upon for essays? Or just...
Well, I'll give you a hint that the stuff that we're talking about in class that's on the lecture notes and in the homework assignments is probably more likely to re-show up in the exam than the stuff that it doesn't. But again, if you don't understand any of these concepts, I am assuming you read the book. I am assuming you're watching the videos. And the videos are also important. So that is your study guide. And it's open book. So I know some of you haven't bought the book yet, but the nice thing is you can buy it on Amazon, download it, and it's a searchable PDF. So that might help you as well. Okay? So, long story short, other questions? Okay, so today we had a homework assignment, and I already alluded to it, but why did I again choose Monsanto for the homework assignment? Yeah?
They bought out that data.
All right, so what was the rationale Bayer's given to buying Monsanto? Well, they're somewhat competitive. Anybody read the stories about this? Yeah.
Well, I mean, general, like in the book when it talks about how to create value, the only reason that you should merge or acquire another company is if the synergy between the two would help to either decrease costs or increase revenues.
Okay.
And since Monsanto is kind of really big in the seed, and the agrochemicals, and Bayer doesn't necessarily have that much exposure to that area, but they also have a lot of experience in chemicals and pharmaceuticals, and it also opens them more to like the North American market. They thought that it could help also the infrastructure of Monsanto could help them push their products more efficiently in the United States.
Okay, so I think that's actually a really good summary of what they said and the rationale, and I actually like the tie into the book on the synergies. So really good answer there. But I guess the summary of his point is Monsanto basically sells seeds, Bayer sells the chemical fertilizer, bug killer stuff, and they're going to put the two together. And basically the other side of it is from a customer standpoint, this goes back to the synergies. The people that have been interviewed, because they sell to the global agriculture, so think big farmers that are making, you know, the big food purchases, or sorry, they're growing the big food, is basically the farmers are saying on the one hand, all right, there's less competition because now I'm going to essentially a global monopolist that's a one-stop shop. And Bayer is now going to control much more of the global agricultural market, and prices are probably going to be higher. But Bayer is going to be much more efficient because I can go to one company and they can actually do it all. And basically by collaborating, then the seeds that I plant and the chemicals I use to fertilize and protect the seeds basically are going to be much more integrated. So, you know, the jury's out on how much consumer synergy there's going to be. But I also think, as you said, Monsanto is probably looking at, or sorry, Bayer's looking at cutting costs by putting these businesses together and looking at ways to grow. So really good answer. But that actually leads to why I chose them to do your homework assignment and the template into Bloomberg. So let's pull up Bloomberg and let's pull up that template with the custom fields. Okay, so here is Monsanto. Here is RV. And here was under custom the homework. The wrong homework number on there. Now, I'm going to eliminate this for now, and we'll add it back. So the one thing when you created the template is you created it using the Bloomberg best fit algorithm, which should have gotten you these 6 companies against those custom metrics in Bloomberg. All right, and again, when Bloomberg was here last week, they talked to you about how to create custom fields. So hopefully everybody was able to create these custom fields without too much problems. Any questions about creating custom fields? Okay, so 2 things I want to do, which I don't know if Bloomberg showed you how to do it. So in this default list, let's say I want to add another company, Bayer. I want to put Bayer on this list. So what I can do is if I click on this little pencil-like thing, then I can edit the list of comparables. And down here, I could actually type in another ticker symbol, and it will add it to the list. So what I'll do is I'll type in here, Bayer from Germany, hit enter, and now Bayer is on this list. Can we see that? Then, if I save this list, I have 2 choices when I save it. One is I can save it for a custom comp list for Monsanto, so that every time I go to Monsanto, this custom list is the default list appears that I would see. Or I can create my own named custom list. So let's say I want to have the Monsanto list of US peers, the Monsanto list of global peers. I could actually start creating multiple lists of custom comps. All right. But in this case, I'll save it to my custom comp list so that every time I come back to Monsanto and type RV, you notice now it says custom. That's the custom list that I just created. And by the way, if I edit the list again and I want to get rid of a company, like I just uncheck it, save it, and when I save it, it will basically save it with the unchecked company gone. All right, now I'm not going to do that because I'm leaving them on this list, but that's another way that you can actually, so I'll discard the changes and I'll go back to the list that we have. So these were the items on the template that I had asked you to add, with the exception of this one, which I actually forgot to ask you to add. So I'm taking it off so I can add it as an additional custom field. So this would have been the homework assignment that you did. Okay? So one of the fields that was on the homework assignment is something called cycle time. Okay? So I want to talk about cycle time, and I want to come back and talk about Monsanto and Bayer and the rationale for the merger. So we didn't get a chance to talk about this during lecture 1, so I'm going to go back to lecture note 1. And in lecture note 1, I'm going to go back and talk about this slide. Okay? So the key to this slide is that, and this is actually a real slide, so it happened in a classroom at Wharton in 2008. So when you see me gone a lot, I do a lot of executive education. At the time I was working with Company A, the CFO was in the room, and we were talking about some valuation issues. And I basically got the following question, which is Company B is our major competitor. These are two publicly traded companies. And we both sell the same products. We both make the same profit margins, 8%. We are both growing at similar rates, and we both have the same cost of capital. And the analysts on Wall Street agree with every one of those statements, and that's expected to continue. So same products, same margins, same growth, same risk. And the question that was asked is, why is my competitor's stock price going up faster than mine? Why are they basically a buy and I'm a hold? And my response to this is back to cycle time. I said, well, what is your cycle time? And he said, what do you mean by cycle time? So let me give you the definition of cycle time. Cycle time is the average amount of time it takes to turn $1 of invested capital into $1 of collected sales. That is what cycle time represents. It's the average amount of time, average, to turn $1 of invested capital into $1 of sales. And here's how you calculate cycle time. The formula is on the slide. So what you do is you take the cumulative invested capital of the firm. That's actually why this week's homework assignment is so critical, because you guys need to figure out how to calculate operating invested capital, okay, and rearrange the balance sheet to get that. But this is the capital that's tied up off the balance sheet at this point in time, divided by annual sales or revenue. So what that tells me is the percentage of a year, since this is annual revenue, to sell the capital. All right? And Joe's innovation to this is to multiply by 365. Because if I take the percentage of the year times 365, that tells me how many days. All right? And that, I think, is very important, because I think language matters. And I do a lot of work with companies because of language. And I'll give you an example. So I used to have a dog. I'd come home and I'd talk to my dog, and my dog would smile, she'd have her tongue out, and she'd listen to me. But I don't think there was any real comprehension there, right? And I think the same is true with a lot of people in the real world, is that you walk into a company and you say, you know what, your inventory turns are 7 and they should be 8, right? And there's nodding and there's agreement, but people have no idea what you're talking about. And they're starting to think, is inventory turns of 7 or 8 better? I don't remember. What's the formula for that? Versus you walk into a room and you tell somebody, you have 30 days of inventory and we want to cut it to 27 days of inventory. Like, you don't need a finance degree to understand that 27 is better than 30. And you're saying similar things. You're just using easier to understand language. So that's why I like the concept of days. And that's what you put into Bloomberg with your custom field. That formula, so we can translate productivity into days. Days of productivity. Here's why this matters. So, using this formula, we took company A and B very quickly, and on a flip chart, created their cycle time using that formula and using publicly available data. So here's the business model of company A and company B. Company A's business model is they make 8 cents every 267 days. Company B's business model is they make 8 cents every 135 days. Which one of those is more attractive? B. Does everybody agree with B? Okay. So again, it's not just how much you make, it's how often you make it. Okay? So per dollar of investment, per dollar of invested capital, the business model of A is they make 8 cents of cash every 267 days, and the business model of company B is to make 8 cents of cash every 135 days. Right? This was the slide in lecture note 1. So going back, if A and B start working on building their products in the same day, how much cash profit does A have on day 135? Company A, day 135. The answer is actually 0. Now, there's some accountants in the room that would write down 4 cents on some piece of paper somewhere, but if you found the cash, good luck, because it's not going to happen. You don't have the cash yet. Right? Company B, how much cash do they have on day 135? 8 cents. Because they get $1 of collected revenue. They spent 92 cents of cash along the way. They net 8 cents of cash profit. Cash profit at Company A on day 267. Cash profit of Company B on day 270. 16 cents. Why does Company B now have 16 cents? I'm sorry?
Lower cycle time.
Yeah, they have faster cycle time, so they're able to complete 2 cycles in the same time Company A completes 1 cycle. Does that make sense to everybody? So let me just be really clear. So in this class, if we take these 2 rows worth of people, okay, and we call you Company A, and we take this single row worth of people, and we call you Company B, you can get the same amount of work done in the same amount of time. That basically, in half the time, is that you, in 267 days, would complete a product. They will complete 2 products in the time it takes you to do 1 with half the resources, because they're better at what they do. Does everybody see that? That's really what cycle time means, is that as a company, I'm more efficient, and I can do the work with less resources. And so therefore, that is very valuable, because it's not just how much you make, it's how often and how long it takes you to make things, and how much you have to invest to make things. So what we do is we annualize the data for comparative purposes. 8 cents every 267 days works out to 11 cents a year of cash generated. 8 cents every 135 days works out to 22 cents of cash per year. I would rather have, per dollar of investment, 22 cents at Company B versus 11 cents at Company A. Everybody agree? That annualized number is called ROIC. That is ROIC. And that's why ROIC is such a critical metric. And this is a different way of thinking about ROIC than it's been previously defined, but I'm giving you a much more powerful understanding of the metric, because it is tied to your operating free cash flow. If you generate more ROIC, you will generate more cash flow for the same amount of growth. You will be more valuable. And there are 2 things that drive your ROIC. It's going to be your profit margins, how much you make when you sell something. But it's also going to be your productivity and efficiency, how much you invest and how long it takes to complete that cycle and turn the investment into collected sales. And those things have equal weight on the performance of a business. Okay? So, here's the key. Let's go back to Monsanto. So this was your homework assignment. And what I forgot to add to your homework assignment is the profitability part of it. Okay? So we're going to add a custom field, which I'd already created, called Operating Return on Sales, OROS. And I'll move it over here. But basically, what operating return on sales is, profit margin in this case, is the NOPLAT, the custom field for NOPLAT, in dollars, divided by annual sales. So in this case, latest fiscal year revenue. That is your profit margin of NOPLAT. So NOPLAT divided by revenue on a percentage basis, doing it on an annualized basis. And then I'm multiplying it by 100 in the custom field because, for example, In CF Industries, it would have come out as 0.0592. So to make it look like the percentages in the other columns, just multiply by 100, so it's 5.92 instead of 0.0592. Okay, that's where the times 100 comes into play. Okay, but it's just basically looking at your profitability. Custom field no plat divided by latest fiscal year revenue, standard Bloomberg field. Questions about that? That's all that field is. You can quickly add it to your terminals, save it to your accounts, because you'll be using this throughout the year. Forgot to add this to the last homework assignment. I don't know why this panel's not on. Nobody usually. Okay, so here's what we know about Monsanto. All right, Monsanto's business model is profitability after tax, no plat, 17 cents every 283 days, which makes 21.9 cents or 22 cents a year of ROIC. That's Monsanto's business model. The business model of Bayer is making 10.34 cents every 287 days, and they make 13 cents ROIC per year. Yes? Okay, so here's the thing. One of the points that was made about the rationale for the deal is Monsanto has a much higher ROIC than Bayer. Right? But now the insight that we can now have is why. Why does Monsanto have a higher ROIC? What's true that we now know about Monsanto? It's not the cycle time. It is lower, but it's not that much different as you think about it as a difference of 287 versus 283. It's really what? It's the margin. Is the margins at Bayer are 10%, and the margins at Monsanto are 17%. See, that's what's attractive to Bayer about Monsanto, is that the seed business of Monsanto is much higher margin business. And that's what they're buying their way into. What's the challenge Monsanto has? Monsanto's got a great ROIC, but what's their challenge that we can see here on the template? They're shrinking. The expected growth rate for 2016 is Monsanto's expected to shrink. So that's the other key to the value. Key value drivers is Monsanto's got a great spread, ROIC versus cost of capital, but the business is shrinking. Bayer has a good spread, and they're growing, but they don't have the spread because they don't have the margins. So what they're doing is they're trying to buy Monsanto to get the better margins. Synergies, let's cut some costs, get our costs up, or our costs out, and get our margins up, and then see if we can return Monsanto to growth by putting these two businesses together globally. I mean, if you boil it down, that's the financial rationale in the numbers to the deal rationale that was explained earlier, and we see it very clearly here in this template. Does this make sense to everybody? Questions about this? That's why you did the homework assignment. And by the way, this is what you'll do the equity screening on, right? Because one thing that you can screen on, if I go to EQS, and we didn't do it here, but for example, here's a screen of, let me do this one. This one. Okay, so here's a screen of companies in the S&P 500 that have an operating ROIC greater than 20%, but have very fast cycle times of less than 50 days. Okay, so one of the things I can say is, who are the very productive, efficient, big companies? Okay, regardless, and are actually getting decent returns. Well, if you look at this list in 2015, these are the companies. It's companies like Fluor, Big Construction, Apple, Humana, MasterCard, Aetna, ironically Ford, Best Buy, Accenture. Okay? Ford's having trouble now, But historically, they were doing a little bit better in 2015. But that's the point. These are the big, relatively efficient companies that we've now quickly, on the S&P 500, we've quickly identified. So again, I'm not saying that they are high margin companies, but they're doing things much more frequently. Okay, so what I really want is I want a company that has a great margin and a great cycle time, and you can see that with operating ROIC. You know who's really attractive? MasterCard. Their ROIC is 539% per year. Right? Why? People are swiping those cards every hour, every minute. Swipe, swipe, swipe. More swipes, more swipe fees. And that's the point. That's MasterCard. And what they're just doing is they're just matching people with the swipe fees. So they are the efficiency business. So that's the point. Drive value by driving growth with very fast cycles. MasterCard, Visa, very valuable companies. Right? Getting there different ways. But I'm just saying, this is the kind of real implications of this stuff. But let's come back. So, does everybody understand the drivers of ROIC that we talked about? Okay. How does this translate into the key value drivers of a business? So again, in the readings, and we didn't have time to talk about this in lecture note 1. So the last slide of lecture note 1, which you read in the book, was this slide. And the formula on the right is the key value driver equation. This is probably the most important thing that I can teach you this semester. It's right here, is understanding the impacts of this formula for any business. This will serve you very well in your careers to understand this. So here's the point. We're going to do this in Excel. Right, so here is a file new. I'll do a brand new workbook. And I will save this. Today is September 21st, video. I'll post this online. Okay, so 2 companies. Make this bigger. We'll call them A and B. 4 parts to this equation, key value driver equation. Profit, which is no plat. Long-term growth rate, G, it's talked about in the book. Long-term ROIC in the future, and the WACC, the expected cost of capital. Those 4 things determine the operating value of a firm. So, 2 companies, identical no plats, 100 million a year. They're both growing 5% a year forever. Similar long-term growth rates. Company A has a 10% ROIC. Company B is a little bit better. What they do, they make a 20% ROIC. Both companies have 10% WACCs. Which of these 2 companies is going to be more valuable, A or B? B? Everybody agree? So, you intuitively said B. I want to quantify how much more valuable. That's where this formula comes in. So, equals no plat times 1 minus growth divided by ROIC divided by WACC minus G. Company A is worth $1 billion. Company B is worth $1.5 billion. For those of you looking for the equation, there it is. But that's the point. You told me B was worth more. I'm just telling you how much more. It's worth 50% more. Why? What's the only difference between A and B? ROIC? Here's the point. ROIC is a proxy for free cash flow. That's why it is such a critical metric. Calculating free cash flow, as you're finding out this week, is hard. Calculating ROIC is easy, and ROIC tells you what your free cash flow is going to be. Here's the key: at the same level of growth. So at the same level of growth, if you have a higher ROIC, you will have more free cash flow, you will be more valuable, and the equation will help you figure that out. But that's why ROIC is such an important metric, because ROIC tells you what your free cash flow is going to be. Right? What is the price to earnings multiple of company A? What's PE would they trade at? 10. The value is their price. The no plat is their earnings. They would trade at a multiple of earnings of 10. Company B would trade at a multiple of earnings of 15. Here's the next thing. ROIC is a proxy for free cash flow. Multiples are a proxy for free cash flow valuation. So they're the same thing, it's just the shortcut. Figuring out a DCF is hard, figuring out a multiple is easy, and they're the same thing. That's why people like multiples. But they're not different than each other. Multiples are free cash flow valuation. You get to the same answer, you just do it with rearranged equations. And that's what you need to start to understand about multiples. And multiples are going to be created by key value drivers, which are on this spreadsheet. So multiples are a representation of the future key value drivers for a business. And those are the drivers. Okay? So let's talk about how these drivers actually affect value and multiples. So let's say company A wins the lottery and doubles its profits. But nothing else changes about the business long term. Still same long-term growth rate, still same returns, still same risks. What's going to happen to the value and multiple of company A when suddenly it doubles its no plat? What happens to the value? What happens to the multiple? Yeah.
It doubles in value.
All right, what about the multiple? You're just going to cut in half? Okay, yep. What's going to stay the same? What about the value? Okay, so let's see who's right. I'll triple the profits. So here's the point. If you make more profit, think more cash flow, you become more valuable because of size. You're just bigger. And bigger is more valuable. But people don't necessarily pay more for those profits. You don't become better. Okay? So one way to drive value, which you both got right, was you get more cash flow. But the next way to think about value is how much do I pay for those earnings? How much do I pay for that future cash flow? It's not based on the size of the cash flows. It's based on something else, the key value drivers, growth, and spread, which are right here. That's why growth and spread are so critical to understanding the performance of a business, right? Because basically those become the key value drivers for the business, right? Which will change the multiples of what you pay, okay? Growth, return, risk. So let's change these and let's see how this affects. So I'm just trying to find a way to highlight the color here, and I love it how Excel shrinks this ribbon bar. There we go. Okay, so those are your drivers of multiples. So what happens if company A grows faster, long term, than company B? So company A goes into new markets, and because they're in faster growing markets, they will grow faster. But nothing about their business model otherwise changes. They still make the same return on invested capital. They still have the same risks, but they do grow faster. So what's going to happen with that faster long-term growth to their value and to their multiple? Yes? Well, let's assume the ROIC stays at 10%. So nothing's going to change about the ROIC. Nothing's going to change about the growth, or sorry, the WACC. The only thing that's going to change is the growth. So what happens to the value? Yeah. All right, you think the value and the multiple will go up? Does everybody agree with that? All right, the beauty of Excel is let's do a little simulation. Let's see. So here is 6% per year forever, by the way. Here's 7% per year forever. Here's 8% per year
You can't see
forever.
the multiple on the screen.
Oh, sorry. Back to 5. 6. 7. 8. Not changing. Let's start this again. 6. 7. 8. 9. What's going on? Yep.
Well, since G is in both the numerator and the denominator, it's affected by ROIC and WACC. And since for company A they're equal, when you change G, when you change the long-term growth rate, it's equally affected in both the numerator and the denominator. So the multiple will change.
So let's go back to what's equal with company A.
What do you mean?
You said something's equal with company A. What's equal with company A? Yeah.
Return and weighted average cost.
Yeah, the return on invested capital on the WACC is the same. So the spread for company A is what? 0. And a 0 spread is 0 NPV. When I grow 0 NPV projects, my value doesn't change. All right? I like to call this the treadmill. You run really fast, you don't go anywhere, eventually you just get tired. All right? That is company A. The difference with company B is they have a positive spread. They're borrowing at 20%. Sorry, they're making 20%. They're borrowing at 10%. They're making a 10% spread. The more they grow, they become exponentially more valuable. So that leads to another point. Growth does not create value. I'll say that one again. Growth does not create value. Growth is the accelerant to value. It's like throwing gasoline on a fire. It's the growth spread combination that determines your value. Right? Because the difference with company A is that company A is growing a 0 spread. Company B is growing a very positive spread. So that's the point. Company A, as they grow, doesn't go anywhere. Company B, as they grow, becomes exponentially more valuable. Okay? So let me show you this at work in the real world. So one of my clients is a company called Merck. Okay? So here's public data on Merck. MRK, ticker symbol. GP, graph their price. 5 years. Here are the last 3 years of Merck stock price. Notice it's flat, it's not changing. All right, stock price is on the treadmill. What would we know is probably happening to Merck spread? Before we even look at the spread, what can we assume about Merck spread? Yeah. Okay, RV, custom, spread template we created earlier this semester. Here's Merck. ROIC last year 7.56, WACC 7.44. 0 spread, flat stock price over 5 years. Everybody see that? What could we assume if I switched Merck to Facebook and I looked at their last 5 years of stock price? What do you think we're going to see? Yes, that's right. Facebook RV, Facebook custom, Facebook spread, it's positive. And what's true about Facebook's growth? It's been very rapid. Positive spread, rapid growth, stock price increases. Merck, doesn't matter what their growth is. 0 spread, you stay in place. That's what I'm telling you. What I am talking to you about right now is fundamental. That if you understand this, you have a really good understanding of the stock market, you have a really good understanding of the core principles about valuation. We're going to dig deep, we're going to get into the math, But when we do all the math, this is what the math's going to tell us. Make sense? Questions? Saw a hand? Yes. That's right.
For a lot of companies as well, so like the biotech firm that doesn't have any returns yet in 4 years, will have a lot. So like their valuation will be very high, even though they're going to have negative.
So what is this really then? So keep going. By definition, what does that G and what does that ROIC have to be? Exactly. This is not, and that was a bias that I just showed you, but actually an incorrect bias. Because what did I show you about Merck's spread? What year was that? That was the 2015 spread of Merck. And the problem is that what is this equation really about? Future spread of Merck. The future spread matters more to investors than the current spread because it's all about future ROIC. But let me flip it around. What are people expecting about the future spread of Merck? Same thing, flat. So that's where I was playing to the bias, but you're absolutely right. So that's the point of this equation. It's expected growth, it's expected return on invested capital, and it's the cost of capital. So it's the expected growth spread. What are multiples? Multiples are just a representation of expected growth and expected spread. That's all they are. But that's also very important as well, because here's the other misnomer that you were taught in your previous classes. I remember one of the exam questions I've seen in earlier finance classes is, you take a private company and they're going to go public, and you see the average multiple in the industry, so whatever that average multiple is the multiple that this company will go public with. All right? What's the flaw in that question? If I take a company public, will they trade at the average multiple for the industry? Yeah. That's right. So what the average multiple means is that you have an average growth and an average spread. And if you don't have an average growth and an average spread, you're not going to trade at an average multiple. That's why it's kind of interesting that people say, oh, buy this company because it's cheap. Its multiple is below the industry. They're cheap. They're trading at a discount. Well, part of the reason they're trading at a discount is they probably have lower growth and lower spread than the rest of the industry. That's why they're trading at a discount. And the only way that they're going to move up is what? The growth would have to change or the return would have to change. So that's the point. They're just not going to go to the average because everybody goes to the average. They're going to have to go to the average because they're going to have to get to the average growth or the average spread. If they don't do that, they're going to always trade at a discount. Same thing with premiums. Facebook is going to trade at a premium compared to its peers because it has a better than its peer average ROIC and a better than a peer average growth rate. So over time, Facebook will be an above average company and they will have a premium multiple because of that reason. That's what causes it to be higher. And that's the insight, particularly when we get to multiples week, that we're going to get into. Yes?
So this might be a fallacy, but based on like what we just said, if you had a company that had negative operating spread, and you were, so growth in that case would destroy value.
Correct.
So if you were downsizing, if they were like spinning off assets or selling it to other companies, wouldn't that technically increase the value of the company then?
Yes. So I was going to show you Tesla, but I'll go right to your point of your question. So everybody sees A and B here, right? Okay. So let's do scenarios 3 and 4. So I'm going to reset this. Scenario 3 is this. You're Coca-Cola. And you tell the world that, oh, by the way, our customers have realized sugar's bad for them, and they're drinking less Coke. And oh, by the way, people now perceive that diet chemicals are even worse for you than regular sugar, so people are also drinking less Diet Coke. That's a problem for us. So what they're drinking instead is water, which we don't make money on. So the problem that Coke is having is we're telling the world we're going to lower our expected long-term growth rate, our guidance, 1 or 2% lower. And they did this a year ago by basically saying people are moving away from sugary drinks. We don't have a good solution, so we're going to grow a little bit slower than you expected. However, we're going to get rid of $1 billion worth of cost. Because if we're not growing as fast, we don't need as much marketers, and we don't need to spend as much on marketing. So we're going to cut our costs to maintain our margins and returns. So what happens to Coke stock price when the growth slows, but they maintain the returns. What happens to the multiple? What happens to the value? Right there. This is repricing. I price you as if. I realized I was too optimistic. I then have to reprice you being more realistic. And when you don't generate as much cash because you're not growing as fast as I thought, you are worth less. Therefore, your multiple goes down. Two implications. What's going to happen to the Facebook multiple when Facebook's growth goes from 7% as they get bigger to 6%, 5%, 4%, to 3%. See, the company Facebook's multiple will go down over time. And it doesn't mean they're a worse company. It just means that as they're a bigger company, due to the law of large numbers, their growth rate won't be as high and the multiple will shrink. Right? And I'll give you a real world example of this today. Look at Google. You can see it in Bloomberg. Look up Google's Class C shares, which is Alphabet. Go to the earnings estimate screen and you'll see the forward multiples, price to earnings multiples, the first one, of Google, Alphabet, for 2016, 2017, and 2018. And what you'll see is the PE on each of those earnings goes down from 23 to 19 to 16 and a half. Why? Because Google's growth rate eventually slows from 19 to 15 to 9. And I'm telling you, it's not because Google's worse as a company, because when they get to 9%, last year in sales, they were 60 billion, and they're going to grow to 105 billion over the next few years. And when you grow 20% of 60 billion and 10% of 105 billion, it's the same amount of dollars. Law of large numbers. But this is where people screw up all the time in the real world. Because what they'll do is they'll assume Google's trading at 23 times earnings, and therefore Google will always trade at 23 times earnings. And that's wrong. Doesn't happen. Because as you get bigger, unless Google keeps growing at an ever faster rate, then their multiple is going to shrink. And it doesn't mean there's anything wrong with Google. It's just the natural area of the world. This happened to China last year. If you saw what happened to China's stock market between January and March 2015, their markets were down 30 to 40%. And I was doing work in China. I remember being in Beijing working with a Chinese bank. And the Chinese felt that it was a national disgrace to see their stock market collapse. And the reason why they felt it was a national disgrace is they were so indoctrinated by everybody, including their government, that 7% growth is what they will do forever, that anything less than 7% growth is a failure. And to be honest with you, it's the wrong way to think about that. And this is what I was trying to explain to the Chinese. I was like, look, basically, you're growing at 6.5%, but your economy's so much larger. Like, celebrate that. That's really hard to do. Like, nobody can grow 7.5% on an ever larger economy forever. The math just doesn't work out. And what I'm telling you is we had governments, we had traders, we had professional investors that were blinded by China's just going to grow 7% forever. And then we woke up one day and we realized that that wasn't going to happen. And then there was chaos in the Chinese marketplace. And I'm telling you, this should have been planned. This should have been predicted. And I'm also telling you that this is what China's got to deal with. Is in a few years, they're going to start growing at 5%. And 5% is not a failure, right? Because 5% on a much bigger economy is extraordinarily impressive. And in 10 years, 15 years, they're going to grow 4%. And the U.S. is growing at 2% right now. And that's the point. 5% in the U.S. is a lot harder given the size of our economy. It's just really, really hard to do. So this is what is true about companies, and we got to recognize will eventually be in the multiples that we see. A lot of people don't understand this. The pros, true pros, do, and that's what you're going to understand this semester. So finally, let's go back to his point. What if you have a negative spread? Scenario number 4. Now do you grow? What happens when you grow? 6%, 7%. The more you grow, the worse you are. This, by the way, is what I told you when I gave you the Molson Coors example. This was Molson Coors' issue. Is they're like, we're company A. We need to shrink. Because what happens when you shrink? 7, 5, 3, 1, -3. Avoid the negative NPV projects. You will create value. But this was the nuance that I showed you in class. Is Molson Coors had two businesses. The operating business was business B, and the non-operating business was business A. So grow business B, shrink business A. That's the right answer. But that's the point. If my incremental performance, as he said, is a negative spread, I don't want to do that. Growth destroys value. It destroys value at a faster rate when you do more of that. You want to see this in action? Right now, this week, there's a lot of information about Deutsche Bank and how bad Deutsche Bank is, and it's worse for Deutsche Bank because the U.S. wants to charge them a $14 billion fine, which is going to make their situation even worse. Okay, so let's just look up Deutsche Bank, DB. And let's go to the RV screen. Now, again, mixing metaphors, but in the banking industry, it's called return on equity. So if I go to the comp sheets, this is the expected return on equity for Deutsche Bank. And the answer is 7% in 2 years. They're expecting a 7% return on equity. In fact, if I go to the earnings estimate screen, return on equity for Deutsche Bank is this year negative 1% because that crazy fine they got to pay. Then 3%, then 5%. That's their return on equity. Their cost of equity is 10.3%. Negative spread. So you know what? Deutsche Bank today is trading at 25% of book value. That's their price to book multiple, 0.25. And that's why. Because they're basically earning 2 to 3% and they're borrowing at 10. And they got billions of euros at risk. It's just devastating. So all that growth is just being written off by the market. And it got worse because now they're going to pay the fine. And they're going to need capital in order to pay the fine, and nobody wants to buy their stock. So Deutsche Bank is in a pickle, right? But let's go back. That's what the key value drivers tells us is going to happen. That's why this is such a critical formula for you guys to understand. So here's the point of Stock Track. Stock Track is about reading an article and understanding how one of three things is going to change. How does it affect ROIC? How does it affect future growth? How does it affect risk? If you can directly assess that, you can directly figure out which way a stock price is going to move. So with new information, how does it affect these key value drivers? That's what will affect the value of the company and its multiple. So that's really why I'm making you do Stock Track. Because what I'm really asking you to do is in the short run, you're playing that expectation game. It's the expectations and how they're changing, which is why it's so hard to beat the market. And you can see it on the spreadsheet. The math for equity valuation is actually really, really easy. Now don't worry, we will make it complicated over the course of the semester. Got to do something for the next 10 weeks. Can't just end the class now. So it will get extraordinarily complicated. But at a high level, it's all not that complicated. You know what makes equity valuation hard? What makes it hard? Yeah, it's the uncertainty of the crystal ball. What's the growth rate going to be? Nobody knows. We disagree. What's the return going to be? Nobody knows. We disagree. What's the real risk of this company? We disagree. That's the problem. The problem with equity valuation is the assumptions. It's not the math. The math is actually straightforward. And that's true in the real world, but that will always be the problem. That's actually why it's so hard to beat the market. Because in the short run, all you're doing is playing the expectation game. You're gambling. And I'll give you an example. In the very first class for Stock Track, when I was showing you the 11 a.m. section, I bought ExxonMobil. As I showed them, I said, I'm going to put that in my portfolio. And of the 4 companies I bought, Exxon's down 4%. I'm doing really well in my other three companies. I'm doing horribly in ExxonMobil. What happened to Exxon right after I bought them? Yeah. Yeah, they're being investigated by the SEC and the New York Attorney General for accounting fraud. Well, oops, there you go. Stock price down 4 to 5% because of that. That was unforeseen. That's the problem with short-term expectations, is that I'm making a bet on what I think they're going to do. New information comes out. If I had known that, I would have shorted them. I wouldn't have gone long. But I didn't know that. That's why those types of events are what makes it hard to win in the short run, because it's all about reaction to information. Why does Warren Buffett beat the market over the long run? Because he says, I'm not going to play the short-term game. I'm going to play the long game. I'm going to play the 10-year game. And if I'm right about 10 years of what the company's returns and cash flows really are, then eventually stock price is going to bounce around. It's going to bounce around, move into that dot. So I'm going to keep pushing that dot longer term. And he's been good at playing the long game. That's why when a company's stock price goes down 5%, he doesn't look at it as panic. He looks at it as, maybe this is an opportunity to buy on sale because long term, they're actually going to do really well. Or he actually sold Exxon a while back because he said when they went down, maybe they're not going to recover, and I was wrong about my point of view, and I need to get out. So this is what you're going to practice. You're going to practice that short-term game as you go through stock track this semester. But it's really the expectation game that you are going to be playing. So with that in mind, the last thing I want to talk about is your next homework assignment. So this is what I put into lecture note 3. But again, this was covered on the video. So unless you have specific questions that came up on the video, right, then, which I assume, I did pat myself on the back. Actually, the video did a good job of explaining it. So watch the video. Because if you don't watch the video, you will not know how to do this homework assignment. Because even if you read the book, it'll still be confusing. So very important you watch that 75-minute video that I posted on YouTube. Because you're going to have to do homework 5 based on that. And this is one of the most important parts of the video. And so here's what it's about. What it says is, what's really unique and different about this class versus any other class that you take is this middle part of the slide. Because in every other class, what they do, and in the real world, they go straight from financial statements to valuation, and we're putting in this middle process. That's what McKinsey does. And it's basically about putting into an economic statement format, taking accounting statements and putting them into an economic statement format. Right? The extra step has value in 2 ways. Right? Number 1, it makes your process easier later. Right? It's more work up front, but when you do it, it makes the valuations much more simplistic, and it makes the analytics much cleaner and more informed. So that extra work does pay off. Number 2, it eliminates errors. Because if you go straight to the valuations, you make mistakes. I'm not saying you can't make a mistake, but going through the process of footing the statements will minimize the mistakes. And what I'm talking about is that when you convert to the economic statements, you will have to balance all of the statements. An unbalanced statement is an incorrect answer in this class. So when you calculate free cash flow in most classes, you stop and you're done at free cash flow. So I don't know if I made a mistake. I could have left something out and I'll have no idea because I just calculated a free cash flow. Well, in this class, you have to calculate where the free cash flow went, and you got to track both the operating side and the funds flow side, the financing side. Where'd the money come from? Where'd you spend it? The two have to balance. If they don't balance, you made a mistake. And that's the key to this class, is by footing things, it ensures you're less likely to have made a mistake. But it will add to your frustration and hatred of me. And unfortunately for you, you're now past the drop add period. So you're kind of stuck here for the rest of the semester. So let's make this process as smooth as possible for you, because you're going to hate this assignment, right? And so here's the assignment. You're going to take these financial statements. This is homework 5. It hasn't been posted yet. It'll be available after the next section because I don't want people working on it during class. All right? It's already rude when people are doing other things like talking during class, but fortunately nobody in this room is rude. Okay? So with that in mind, because I'll just throw you out of the class and embarrass you. So that's your one and only warning. So in terms of this, in terms of the class, this is homework 5. And what you're going to get is you're going to get a detailed income statement and you're going to get a detailed balance sheet, and you're going to get, and you'll see this in the video, you're going to get the labels. Everything's labeled 1, 2, 3, 4. So you don't have to figure out what's operating, non-operating, debt, or equity. I will give you those. And then you have to create the solution. And the solution, which I won't post until later, is going to look something like, well, I don't want to show it to you because it's on video. But the solution is going to have 3 additional tabs. It's going to have a TFI tab, a TII tab, and a CFI tab. So you have to convert tab by tab, and again, the video explains this, to create that solution. Here's what I think will happen. It'll probably take you about 30 minutes to convert the income statement and balance sheet. And most people should not have too much trouble, and you'll get that done. The cash flow statement, which you can convert the income statement and balance sheet without converting the other, meaning it doesn't matter which one of those 2 you do first. But you need both of those to create statement number 3, which is the cash flow. The cash flow statement will take you between 45 minutes and 5 hours. Right? For the people that take 5 hours, you'll probably just quit out of frustration. Right? And the people that take 45 minutes will get it done, and will get it done right. So I expect the entire assignment to take you about 75 minutes after you watch the video. So here's the thing. What's going to cause the cash flow statement to be problems, I've talked about in the video. I gave you 3 tips. Make sure you follow those 3 tips. And the biggest one I'm going to spend 1 minute on here before I turn you loose, which is basically, this is what's different about accounting. There's 2 sides of these statements. Think of it as the cash you generate and what's called the financing or fund flow side, the cash that you spend. They have to equal each other. So here's the idea. If I make 20 cents of free cash flow, $20 of free cash flow, and I pay it out to my shareholder, then I will have $20 of dividends to the shareholder, positive 20 on one side, positive 20 on the other side. So payouts are going to be positive because the statement is not about absolute value. It's about actually balancing. So McKinsey didn't use GAAP to do this. They did their own format. You have to think of it that way. If I'm short $20 because I lost money and the shareholder writes me a $20 check, negative $20 profit, negative $20 equity investment into the firm. So basically, that's what's key to all the bottom 3 sections of all of these statements. It's explained in the book, it's explained in the video, but that's the biggest hint that I'll give you that will cause the biggest frustration and the biggest challenges associated with these getting the balance. So make sure you complete this by 10 a.m. on Monday. During Monday's class, we will go through the solution in detail. Okay, good luck. See everybody on Monday. This YouTube video will be posted shortly.
Have a good weekend.
Yeah, see you as well. Thanks.